Hi, this is Thejes Kumar. I am an undergraduate student in the Indian Institute of Technology, Madras, India, and I'm currently in the first year and I'm pursuing my BTech degree. The agenda I'll be talking about, mostly I'll be comparing Volkswagens with Tesla, and in the end, I'll be choosing, I'll be giving a recommendation of one company over the other based on the major trends, the crude oil impact, regulatory challenges, HOLT valuation, and technical analysis. If you have a look at the sale of passenger cars, we see that for US, Germany, and Japan it has been more or less stable, whereas for China it has significantly increased. Over here, if we have a look at the world light vehicle sales forecast, we see that it has been good, and we are looking at a 2.56% CAGR, which is actually very good, and the low oil price will also directly impact this and could add 5 to 7 million units over the forecast period. Brief overview: Volkswagen Group, as we all know, it's a German-based car maker and is one of the leading vehicle manufacturing companies in the world. It sells over 10 million vehicles and generates about 200 billion euros in revenue, and it also believes in inorganic growth and has acquired many companies like Audi, Bentley, Porsche, and Skoda. Tesla, on the other hand, is headquartered in Palo Alto, California, and its company's products are mainly aimed for customers in the high-end sphere of the market. Tesla mainly delivers to the USA and Canada, that is, it mostly concentrates on the North American and the European countries. If you have a look at the trends and the KPMG Automotive Executive Surveys, we see that efficiency is the topmost trend for the last 3 years. New energy cars was at position 3 for 2012 and 13, but has dropped to 5th position in 14. Not a good sign for Tesla. And lightweight materials, which was the least in 2012, has now the second most important trend in 2014, which is a good sign for Volkswagens. If you have a look at the the global automotive executive surveys, the percentage of respondents which rate a trend as extremely important are very important. We see that emerging markets, standardization, and IC optimization of the top 3 as compared to battery e-mobile, which is a good sign for Volkswagens and not so much for Tesla. If we have a look at the factors which are likely to influence customer buying decisions, we see again fuel efficiency, safety innovations, and ergonomics and comfort are the top 3 as compared to use of alternative fuels and environment friendliness, which is again better for Volkswagens. If you have a look at the percentage of suppliers choosing technology, they plan to invest most in ICE downsizing as compared to fuel cell or hybrid fuel systems, which is again better for Volkswagen than it is for Tesla, and this has been taken over the triad in the BRIC nations. Even the percentage of OEMs choosing technology they plan to invest most in is again the ICE downsizing in the triad nations, which is much more than fuel cells or hybrid fuel systems. The percentage of respondents rating risk of overcapacity is very high or high. In Germany, France, USA, and Japan, we see that the perception of risk has gone up significantly from 2013 to 2014. Therefore, this means that they're more likely to leverage their existing capacity rather than build new ones, and this is a good sign for Volkswagens rather than it is for Tesla. We have a look at the e-mobility areas of investment in the next 5 years. We see fuel cell tech, e-motor production, battery tech have gone down significantly from 2013 to 2014, which is not really a major thrust for Tesla. By 2025, the e-vehicle registration is likely to pick up with touching around 11% in Japan, USA, and Western Europe, but it may be a bit too long before it really catches up. The reasons to buy or not buy an electric vehicle. The reasons to buy are obvious. It's environment friendly, no fuel consumption, and low operation cost, whereas the reasons for not considering it are incomplete charge facility, as it is inconvenient, the too short a range, and immature technology. And we see that the infrastructure to overcome these issues have also not yet caught up, and hence these issues are likely to persist for some more time. If you have a look at crude oil and its impact on automotive industry, we see that the price of crude oil was around $120 per barrel in 2012 and has gone down significantly to $60 a barrel in 2014, and Goldman Sachs has predicted it to hit $39 a barrel in 6 months, which is a really good sign for Volkswagens. However, this means that fewer customers are willing to pay for fuel efficient technologies, and that electric vehicle sales, which are generally the most expensive technology, will suffer the most, which is not that great a sign for Tesla. If you have a look at the regulatory challenges, we see that the regulation has been more tighter in Europe, USA, China and Japan, and that the management has been so far focusing on low-hanging fruits. By 2020, ICE will still account for more than 90% of the cars, and the concentration will be on developing more advanced ICEs, whereas only beyond 2025 will the pressure to look at alternative powertrains prevail and Tesla have an opportunity. If you have a look at the visions and goals, we see that the Tesla vision is to sell 500,000 cars by 2020 and 1 million by 2025. It hasn't been able to meet its 2014 target, and its 2015 target is quite steep. We see for Model X there has been consistent production delays, and for the last 1.5 years production capacity has only been stable. Whereas for Volkswagen's, its goal is to sell 10 million vehicles a year, and it has achieved it in 2014, and also to have an above average share of growth in all major growth markets. And we see in Western Europe it has well above average share of 25%, which is really good, and also we see the top and bottom lines are also really good. We see that Volkswagen has consistently, apart from North America and the rest of the world, Volkswagen has outperformed the overall car market in terms of growth in deliveries to customers year on year. If we look at the HOLT valuation, we see Volkswagen's 2011 onwards, the CFROI has been good and consistent and above the cost of capital, and the predictions for the next 2 years are also good. The asset growth has also been quite good, and the price of the stock relative to the European index has been consistently going up. The sales had slightly dipped in 2009, however it has picked up since, and the operating margins have been quite stable. If you look at the price tracking, we see the warranted price is well over the actual price, which means that Volkswagen has been undervalued for quite some time, and that even in the worst case scenario it has been undervalued by over 51%. If we look at Tesla Motors, the CFROI has understandably been negative during the inception years, and has just about managed to catch up with the cost of capital, and it's currently in the growth stage of its corporate life cycle. The asset growth it's also just starting creating assets. The operating margins have also understandably been negative in the inception stage. The price tracking, we see that the actual price is much more than the warranted price, which means that even in the best case scenario, Tesla Motors is highly overvalued and is 42% overvalued. Applying technical analysis, we see in Jan 2015 for Volkswagens, all the three moving averages converged, and this is called as a golden cross. It has also broken the resistance of 200 and has been on a bullish trend since. Since it's on a bullish trend, moving averages would be the best indicator compared to oscillators, and we would advise investors to buy or accumulate at every price dip. For Tesla, however, all the three moving averages again converged in Jan 2015. However, it has been on a consistent negative trend since September 2014, and hence making lower tops and lower bottoms, and hence this is a negative golden cross, implying unwinding by investors, and we advise the investors to sell at every price rise. The summary, if we take into consideration the trends in executive summary, crude oil, current performance and goals, visions, HOLT valuation and technical analysis, we feel that Volkswagen is an outperformer, whereas Tesla is an underperformer, and prefer Volkswagens to Tesla.